All right, I want to start off with some of the news of this morning. We're seeing oil prices move higher on sanctions on Venezuela and also potential sanctions on Russia. Does this idea of the potential for oil to move higher, at least we're seeing that move this morning, does it change your view of any sectors of the markets in general?
Sure. Look, I mean, oil prices have so far not contributed to the inflation pressures in the U.S., which obviously helped the Fed cut rates. This is a key indicator that we're watching. If this is going to continue, obviously that could slow down the easing path of the Fed, given that they're giving more importance to the employment rather than inflation at the moment. But I think it's still very early to tell. There's still time to see that spill over into the CPI data. So no change at the moment.
All right. Your word of the day is rotation. Is that what you're seeing in the market right now, and something that you're bullish on, the idea you're rotating possibly away from tech into either cyclicals or some other underloved parts of the market?
Sure. Rotation is I think it's going to stay for a while. The fact is that, the capital is basically moving away from the high multiple mega cap winners into the more small caps, the cyclicals and international markets. I think that will continue, given the fact that, again, the monetary policy will stay easy coming from the Fed with the end of the quantitative tightening and obviously the Fed rate cut, but also the fiscal policy will be felt more strongly in the U.S. economy in the next few quarters.
Okay. You mentioned small caps. You actually like the S&P 600. Why do you like that part of the market, excuse me, other than just the small caps or just the broader index? I was just taking a look at it. When you look at it, it's about 17% industrials, double digits when it comes to also financials. I know financials are your pick for us today, but why do you want to play it down cap? Why not play it up cap?
We like down cap because they're still undervalued. The fact that obviously rate cuts are now coming into the picture, and small caps in general, they outperform when we are further into the rate cutting cycle. So that's one thing. The second one thing is obviously the fiscal policy and the new tax bill helping the R&D intensive small caps particularly able to expand their R&D expenses basically. So that's also very positive for small cap. But we like quality, high quality small caps, and that's the reason why I selected S&P 600, because we think that liquidity is more expensive at the moment, and therefore you really need to look for those companies with strong balance sheets, consistent cash flows, when you are looking to invest in the small caps.
But your actual pick is financial. So are you saying small cap financials, big banks? When you're looking at financials, are you playing the broader sector, or are you being more of a picker and a chooser?
Broader sector, we are very optimistic about. I think regionals have more room to run still. Obviously, private credit has brought them under pressure. But overall, for financials, I would say that the fundamental backdrop is very strong. Obviously, we're seeing now the steepening in the yield curve thanks to Fed cutting rates and the long end of the curve coming under pressure, leading to higher rates there, which is positive. But also, very importantly, financials is now the second strong earnings season in the S&P 500 with 25% year-over-year earnings growth expected, behind only tech. And obviously, we're also seeing capital markets activity coming back into the picture, a pickup in M&A activity, IPOs slowly picking up as well, which are all positive for financials. Here, again, we like banks. We do like insurance as well, and capital markets activity, the banks that are more tied to that.
So you're mentioning IPOs. We're going to get our biggest IPO of the year actually going public later today with Medline. Is that also making you bullish just about the IPO path going into next year, and also the fact that there's actually a bit of a bottleneck from the government shutdown? So more than likely, we are going to see a number of IPOs that were actually halted because of the shutdown. They couldn't file the papers.
Correct. I think the obviously liquidity is coming into the market again, which is positive for the IPO market. Again, the fact that monetary policy is in an easy position as well will help the IPO market. So overall, we are positive.
All right. I want to talk about a data point you sent us. The idea that people are going to get tax refunds in the range of $100 to $150 billion next year. We heard the Treasury Secretary talk about it as well a few days ago. He said that's about $1,000 to $2,000 per household. What is in your mind, what does that mean for the markets? Does that mean more for the economy or for the markets? Because we just had a guest on earlier that people kind of buy big ticket items. Does that also give a boost to the market?
I think the market is pricing that in. The fact that it will likely be felt in the first few quarters of 2026. As you know, the market is forward-looking, but the reason why I picked rotation as my word of the day is the fact that, again, consumer stocks particularly is pricing a major boost to the consumer sector. Again, 150 billion in the form of tax refunds coming into the picture in February 2026. So that will boost the more consumer sensitive sectors. It could be home builders, it could be banks, as we talked about, and discretionary in general is having a boost. So I would say both macro, which will be felt later, but markets, it's what we're seeing at the moment.